Hello, everyone. Welcome to a Wall Street from Main Street podcast. My name is Dawoud, alongside Jason Burack. Today's special guest is Rick Rule. Rick Rule is the founder of Global Resource Investment and Sprott Asset Management USA. He's also the general partner on the Exploration Capital Partnership, which are a series of successful investment partnerships that have been in operation for more than 10 years. In February 2011, these businesses were acquired by Sprott, and Rick joined the investment and management team at Sprott. Rick Rule has been a successful natural resource investor for decades, and we are happy to have him on our podcast. Rick Rule, thank you for joining us.
Thank you for having me. It's a pleasure.
Great. Now, Rick, before we dive down into your view of the resource sector, the commodity bull market, and maybe some of the individual companies like Juniors, what is your view of the macroeconomic situation? Because I think that impacts investing and where to allocate capital. Are we in a worsening stagflation, or do you see things differently?
No, I think we are in worsening stagflation. I think we're sort of in a bifurcated market in that the developed Western economies have lived beyond their means for, 2 or 3 decades now, which is obviously problematic. And interestingly, the economies that used to be the basket cases, the emerging and frontier markets, which really lost their access to capital markets in the early 1990s, have much better balance sheets than developed economies, have large foreign exchange reserves relative to their flow of domestic currencies, and importantly, are becoming slowly more free, which means they're becoming rapidly more rich. So I think in an overall weak global economy, you're seeing a transfer of leadership from the sclerotic, overgoverned Western economies to the emerging and frontier market economies. And I think that's important in the context both of understanding the world economic picture and also understanding commodity markets.
Yeah, and I think that's some really good points, Rick, because here in the developed world, you have the U.S., the UK, Japan, and all these guys are just they're misallocating massive amounts of capital and resources. They're crowding out the private sector. I actually don't think crowding out is a harsh enough term. I believe they're cannibalizing the private sector. They're stopping, entrepreneurship and a lot of small business growth just to maintain the status quo so government can get its money, its access to borrowing cheap, and keep on spending for its welfare and its warfare state.
I couldn't have said it better.
Great point by Jason and by you, Rick Rule. I want to talk about the stock market. In the past couple of years, we've seen a lot of retail and institutional investors move from the stock market into the Treasury bond market because they think that it's a safe haven, even though the yields are almost zero and they get almost no return in these Treasury bonds. Do you think when do you think that retail and institutional investors will move back into the stock market and out of the bond market?
Well, timing's an interesting question. The equity markets themselves have been described as being in the short term voting machines and in the long term weighing machines, meaning in the near term they manage emotion and in the long term they measure reality. Given that I've never been particularly comfortable with the way people vote, I don't regard markets themselves as sources of information, but rather as facilities to, buy and sell assets on. I'm amused with the Jim Grant quote with regards to long-term debt, which he calls return-free risk. And while I understand that what you're saying is true, I think it's a rather large mistake, and one I don't have any personal interest in emulating. Return-free risk is not high on my list of objectives.
I think that return-free risk is a great quote, and I think a lot of it is because there's just so many people on Wall Street that believe everything, even 10 years working on the street, that everything in the textbooks is right, that Keynesian economics is right, that inflation is not a problem, that deflation is always the problem. But, Rick, you're an Austrian school type guy, you're an Austro-libertarian, and deflation is good. You want to grow purchasing power, you want to encourage people to save, and you want people to allocate capital properly.
Jason, I'm also an old man. And one of the things I've noticed in markets is that people's expectation of the future is set by their experience in the immediate past. And the fact that the so-called risk-off trade to U.S. Treasuries has worked in the last several years has inured people to think it's always going to work. The fact that there isn't too much lower for interest rates to go, which means that the possibility, not the probability, of increasing prices on debt securities becomes increasingly tenuous, because how can you increase the capital side of the trade if the yield side can only get hurt?
Yeah, that's very interesting. And I mean, the relationship between, printing currencies and buying bonds with them that the governments are doing and their central banks are doing, it seems that both are being planned to be devalued very slowly.
I think that's right. There's a war on savers right now. There's an income transfer from those who were prudent and saved for their retirement and those who didn't. And unfortunately, those who didn't, those who weren't prudent, outnumber those who were.
And if anyone has been paying attention to what's going on in the black market, obviously it's been manipulated, mainly by the Federal Reserve. They're trying to keep the yield flat so the government can borrow as much of money as they want at almost low interest or zero interest. But a lot of people are asking, when will the bond vigilante show up and send the bond market into a spiral? Do you think that event might happen anytime sooner, or that's something that may never happen because the Federal Reserve is monetizing all of the U.S. or almost all of the U.S. debt?
Well, the Federal Reserve is doing what it can, and again, I reemphasize people's expectation of the future is set by their experience in the immediate past. One needs to remember Ambrose Bierce and others have talked about the root word of confidence, and this is a confidence, about the root word of confidence being con. And in this particular case, the citizenry, the electorate, and the market itself would dearly love to be conned. The set of circumstances that you have to contemplate in thinking about the set of circumstances that would unhinge the U.S. bond market are extremely unpleasant, but people need to think about them anyway. My suspicion is that the catalyst for something like that will be, what has been described as a black swan, some sort of asymptomatic event that causes the confidence that participants have in the market to be shaken, such as the set of circumstances that occurred in 2008.
Yeah, and they haven't seemed very likely to allow any free market forces because, allowing Lehman to fail in 2008 could arguably the only free market forces that they've really actually allowed recently. So I just don't know here because I'm seeing bubbles being blown up all over the place. I mean, they've basically been able to put in an artificial bottom in a lot of the housing market. The home builders are still rebuilding, and people are starting to buy more houses. Some of the inventory, I guess, is being rented out. You see the bond market in a bubble, and the stock market, I mean, the dividend yields on the P ratios and the dividend yields, I mean, you are paying up like over 30 times forward earnings for a stock like Coca-Cola with no growth. That's how desperate this market is for yield. It's just really astounding to me. I guess there's just so much money, right, that's being printed, and it has to go somewhere.
I think that's it. The availability of cash in the system, particularly short-term cash, is extraordinary, and hence the expectations of yields are extraordinarily low. I don't happen to agree with that way of thinking, but the market isn't of a habit of asking my opinion. So I'm not particularly surprised by the turn of events. But I think that there are, unfortunately, because I wish we could go on like this forever, I think there are events on the horizon, things like student loan defaults, municipal government defaults, continued soft earnings, never mind the sense that at some point in time we might require Operation Twists or quantitative easing to fund the entire deficit rather than half the federal deficit the way we're doing now. Remember again that if the root word of confidence is con, at some point in time, I think that market participants will be leery of being conned. I certainly am, but I'm perhaps the leading edge there.
And that's a great point. And I want to transition to the natural resource sector, which you've been investing in for decades. So let's talk about the macro situation affecting the junior mining sector. We have a lot of the juniors that are struggling to survive mainly because they can't get the financing, or they lose their shareholders, or they haven't put in a great plan to get these mines in production. In relation to the macroeconomic situation, has things drastically changed from even 2 years ago for the junior miners in terms of getting financing?
Well, I think the juniors are their own worst enemies, and I think they got what they had coming to them. They have underperformed as a class for years and years and years. Private markets are always better than the government in any economic endeavor, and that includes counterfeiting. As fast as the Federal Reserve has printed phony greenbacks, the Canadian dealer network has printed phony share certificates at a much greater rate. And so although in 2009 and 2010 share prices didn't go up, market capitalizations did as a consequence of the printing of an incredible amount of phony baloney paper. And the success accorded the juniors who spent these vast amounts of capital were absolutely deplorable. John Kaiser, a noted newsletter writer, pointed out about 4 months ago that over 50% of the companies on the TSXV shared several common characteristics. One, they had declined by substantially more than 50% in price over the last 12 months, so they had a very unhappy shareholders list. They were selling south of 10 cents a share, 20 cents a share, so they were true penny dreadfuls. And they had less than 6 months of worth of working capital. In other words, 6 months stood between them and extinction. It would appear, unless the market changes, that over 50% of the companies on the TSXV are headed for extinction. What I have to say to that is good riddance. The attractiveness of the sector has been the performance that's been demonstrated by the top 5 or 10% of the issuances in the sector. People who are not stock pickers, people who don't know how to differentiate between the good, the bad, and the ugly, should get out of that sector, because if you allow your broker to sell you the sector itself, he will do his job, and you will get broker and broker and broker. The junior sector as a whole is perpetually overvalued. It is the performance of a small subset, which is so spectacular that it adds credibility and, in fact, luster to the sector. So I think that the junior sector itself goes inexorably lower over the next 18 months. But I think the best 10% of issuers in the sector have already begun to bifurcate and are already moving up.
And I think that's an important point you brought up, Rick, because you've just seen over the last 8 months, you've seen Yamana Gold buy Extori Gold, which had, their deposit, I think, was past feasibility, and it was moving its way up to a construction decision for a feasibility study. And that was over $1 billion worth of assets, and I think it sold for $400 million because Extori Gold didn't do a financing back when the gold price was much higher. And these management teams at these juniors, like a lot of them are just technical guys. I don't know if they have the good financing people there. I don't know if they understand the macroeconomic situation very well. But when they needed to raise money 18 months ago when the market was better, a lot of them didn't. And now when they need to raise money, it's just near impossible for some of them. And you're starting to see the situation here like Andina Minerals, Orco Silver, where the management team doesn't want to deal with it anymore, and they just start selling out the assets for pennies on the dollar.
Well, the truth is, in terms of capital availability, here at Sprott, we have several $100 million that we'd like to put in the working sector. But there is often a denial on the part of management teams as to prices and terms, which is ironic for us. We see these companies in need of capital, and there are some teams that we know and love and trust. But the gap between the bid and the ask, despite the desperate need on the parts of the issuers, is still there. Of course, you referred to technical teams that didn't have financial acumen. If you look at the TSX venture, what you'll discover is that 80% of the teams in place have neither financial nor technical acumen. They came into being during periods of time when capital was extraordinarily easy to raise, and they raised what they could, and they're paying the price now, as are those who gave them the money.
And that's a great point there. And we're seeing a lot of the gold and silver companies that are more developed buying these smaller companies in discounts, and I expect to see that continue on down the road because a lot of these smaller companies don't know what they're doing, or they don't have the finance or the capital to do it. So I think we could continue to see more consolidation in that sector. Well, I want to move on to other commodities, such as the uranium, natural gas, coal, and other base metals, which have gotten clobbered, losing more than 80% of their market cap in the last few years. What fundamental factor do you need to see from these companies before you start adding positions as a value investor?
Well, first of all, you need to know that something that's lost 8% in value is by some definition 80% less risky. And I am tempted in some circumstances just in the context of price. But certainly what we look for are specialized management teams. That is, management teams that have been successful in prior endeavors that are very closely related to the endeavor that they're setting themselves now. Somebody who has been successful in, say, mine construction or mine operation as a gold mine in Archean terrain, French-speaking Quebec, and proposes to be a success searching for copper in the Andes in Spanish-speaking Chile in, tertiary volcanic rocks, is not somebody I back. Although they were successful in mining, they weren't successful in the type of endeavor that they're currently involved in. So we look for specialized management. In the context of, pre-feasibility or preliminary economic assessment stage companies, look for companies that will be lowest cost quartile. We're not looking for someone for leverage to the commodity price, those large low-grade deposits, as we are companies that will be financially accretive to the people who take them over. So, with regards to the commodities, as an example, we believe that uranium companies are attractive simply because the uranium price has fallen so far, and the prices of the equities associated with uranium have also fallen far. We are attracted to the natural gas price, but we think that'll take 2 or 3 or 4 years to play out. We have the patience to do that, but maybe many of your listeners or readers don't have the patience to do that. We are looking selectively at met rather than thermal coal deposits. With regards to rare earths, we think they have farther to fall. They aren't particularly rare, and our suspicion is that if the Chinese pricing umbrella holds, that we will find large amounts of rare earths. So we believe that those have farther to fall. We are not attracted necessarily to the rare earths market now. But with regards to the other commodities that you mentioned, uranium, natural gas, and coal, with regards to the first two, we're active participants now. With regard to the coal, we're looking with special interest.
Yeah, that's very interesting, Rick. And, with the world population staying at 7 billion, unless we have a World War III or that type of incident where many millions of people are just wiped off the planet very quickly, I see the global population wanting more energy. The developing world is consuming more energy. In a lot of cases, that energy is subsidized. So you're seeing massive amounts of increase in consumption in energy per capita in the developing world. And even if, there's substitution or demand destruction here in the U.S. or Europe for oil and other types of energy, the developing world has underconsumed energy so much that I think it's still a growth story to me. Do you see things that way?
Exactly that way. Lifestyle's key, and it's unlikely to me that Western world energy demand on a per capita basis will decline much, because if it did, there'd be a revolution. Your second point is equally, if not more valid. In emerging markets countries, people are becoming slowly more free, which becomes becoming rapidly more rich. And when poor people get disposable income, the things that they spend money on, the things that they have utility, are things that are made as commodities. In the Western world, we buy more services. We might buy an iPod, or we might load the iPod with, movies or books or records or something like that. In emerging markets, people consume more calories. They consume more energy. They upgrade a mud hut to a cinder block hut. They put a metal roof in place of a thatch roof. The point is that there is rapidly increasing demand per capita spread over literally billions of capita. As those people get more money, they are able to compete with you and I on a more even ground for the world's energy resources.
And that's a great point. I wanted to talk about uranium a little bit more specifically. Ever since we had the Japan tsunami and they had the meltdown at the nuclear power plant, the prices of uranium have been affected and it plummeted. And a lot of the uranium mining stocks took a big hit. Now that the situation has settled just a little bit and the uranium market settled as well, how do you think this will affect the uranium industry in the short term and the long term?
I would suspect that the recovery in uranium has already been begun. The set of circumstances you described, which was the meltdown at Fukushima, was tragic, and it had a couple of very interesting short-term implications for the uranium industry. First of all, the announcement by the Japanese government that they were taking Japan temporarily offline removes 15 or 20 million pounds from worldwide demand. In other words, you took 15 or 20 million pounds out of a 190 million pound market, which was extremely important. The second thing that happened is that you put 15 million tons of supply, that uranium, which was an inventory in Japanese reactors, on the market. So you had a 30 or 35 million pound swing in a 19 million pound market. That event itself took the spot price of uranium from between 80 and 85 a pound, between 40 and 45 dollars a pound. Now, the Japanese said that they were going to phase out nuclear power going forward so that they would be totally non-nuclear by 2040. That to me is absolute nonsense. The Japanese have, as a consequence of their existing phase down, driven the world's liquefied natural gas market crazy. They've taken the price of liquefied natural gas prices up by 30% in the last year and a half, and they have driven fuel bills in Japan absolutely crazy. Of probably more interest is two different things. One, JOCMEC, which is the Japanese government arm that's responsible for investments in other countries to obtain resource supplies for Japan, very recently signed a deal with Uzbekistan to explore for and develop uranium deposits. Why would you consign tens of millions of dollars to secure supply of a commodity which you weren't going to use? Very interesting set of circumstances. Separately, there was an election in Japan that is just over, and the party that won that election is the traditional pro-business, pro-uranium party. So I would suspect that the recovery with regard to uranium has already started.
Yeah, and Japan is running trade deficits now, so it's not like they can reinvest their own citizens' money, their corporations' money, and the budget surplus that their government's running, because they have none of those now anymore. You have a citizen group and a corporation group that really don't have much savings. They've been buying JGBs and sacrificing their savings or holding cash for decades, and their savings rate has dropped drastically. And then you have their budget deficit from their government, which is already many percent, hundreds of percent of GDP, and they're using that on social programs and other things. So I agree with your argument there, and I don't see Japan being able to transition successfully away from nuclear power. They're not going to be able to afford doing it, and they're not going to be able to do it quickly either.
Further, the Japanese have a policy of energy security because they have so little energy in place. Uranium energy is the most dense form of energy supply in the world. The Japanese cannot store 10 years of electricity because it doesn't store, or 10 years of hydro, or 10 years of liquefied natural gas, or 10 years or 5 years of petroleum or coal. But you could easily store 5 years of uranium, and you could store that in a fairly small place. From a geopolitical standpoint, given the lessons that Japan learned in the 70s and the oil shortages, energy self-sufficiency, at least in the context of storage of energy, is important national policy for Japan, which is, after all, a highly industrialized and very energy-dependent nation. And the only commodity which gives them some security of supply is uranium.
That's very interesting, Rick. And I have one final question here before we wrap up the interview, and it's one commodity that most people are not very familiar with because it doesn't trade on markets, but we use it every single day. You have said investing in water is a good long-term trend you really like going forward. Do you think fracking water cleanup stocks are one of the best ways to play that trend and piggyback the shale oil boom?
That may be the case. It may not be the case. It isn't a sector that I am as familiar with as some people are, because technology, service, and supply is not something that I have done in the course of my career with any success. I myself am a resource investor, and so for myself, I either want to buy water rights directly or I want to buy companies that control water as a resource. While your theme may be of interest, it's certainly of intellectual interest to me, it isn't a sector where I have enough expertise that I feel I'm competitive, and I wouldn't want to prejudice your readers with my own suppositions.
And that's a great point. And Rick Roll, we appreciate you coming on for Wall Street for Main Street for a podcast. If people want to find out more about your work, they can go to the Sprott website, is that correct?
Yes, I'm available at www.sprottglobal.com. That's SPROTTGLOBAL.com.
Thank you, Rick Roll, for coming on. Hopefully you can come on for another podcast soon.
I look forward to it, sir.